Fine, ready.
Hi folks, good afternoon. Hope you're having a good week. We are kind of halfway there and today is such an important day. First of all, welcome to Who Moved the Market. I'm Surabhi Upadhyay and with me today on the show is Nimesh. And Nimesh, I think this is that one moment, that one day that markets around the world are...
D-Day, so to speak, right?
D-Day at the edge of our seats, right?
Yeah.
As if there's going to be this major release. 10 hours, basically it's 10 hours from now. We will
and
have
the good part is
Fed decision.
everybody's tracking Fed now. I mean, everybody's become an expert in global markets, so that's a funny part of it.
Oh, absolutely. So, as of last count, the probability is almost 88% that we are going to get this 25 basis points rate hike. And you know, I was speaking to someone and it's become so funny, and this person who's in the market said to me that, look, they should hike today. If they don't hike, it's a problem. And I said, what funny markets we live in, that in case there's a Fed pause or there's a Fed cut, then markets might sell off. As long as they hike, I think markets will be happy.
25%, then they're okay. I guess 25% is like a given thing that if it happens, I think markets will move on. And as even Naren said, right, today, once the Fed outcome is out, maybe you'll see a bit of a relief rally. So I hope so that works out.
Absolutely. We live in interesting times where markets are actually, you know, wanting a hike from the US Federal Reserve. So just a step back in terms of, you know, what got us to this point. So markets, not just equities actually, even whether you're looking at the bond market, you're looking at the way yields are moving in the US, you're looking at the dollar slightly higher. I think the commodity markets around asset classes are poised for a 25 basis points rate hike. So it's really important for the Fed to deliver. And typically they do. The Fed never comes in and shocks the market. That doesn't happen.
It's the other way around. You know, the market forces Fed to do the way what they want, right? So that sometimes that works out in favor of the market. But you know what? I was talking to a lot of global experts, Indian experts as well. The one bottom line is, while beyond this Fed outcome and what beyond this Fed meet of 25 basis point, I guess there is a seriousness of the US slowdown, and that would mean there will be an earnings cut as well. So there is going to be a big challenge for markets, equities globally, and that's going to be an impact on India as well. Thankfully for India, we have already underperformed. We are down 6%, while the S&P is almost flat, right?
Absolutely.
Compared to the DM markets and EM markets, we are down 8 and 10%. So we've actually underperformed since the beginning of the year. So to some extent, we are a little priced in. But for the US, I guess the big challenge is going to be what happens to the earnings and what happens to the the tech companies, the so-called still expensive companies, and that's where the big cracks can come later in the half.
No, absolutely. I mean, your point on underperformance is so well taken, and we had our problems and this underperformance well before the global crisis that even started, before the banks started blowing up, before you had the yields run away and this higher for longer trajectory in terms of interest rates. I was looking at the data. I mean, despite this whole banking crisis and this whirlwind, some of the European markets like the CAC and the DAX are still up 7-8%. And we are down, I mean, almost 6%.
Exactly.
So it's a huge divergence.
Imagine the mother market, S&P is flat, on marginally negative, and we are down 10%. So we've actually done a lot of underperformance thanks to our own problems, thanks to the global problems. I guess, beyond that, I think the biggest reason for India's underperformance is the fact that whole of 22 we were the big outperformers. So we started this year on a very high pitch, and I guess that's what we're just doing a bit of a mean reversion from what we outperformed last year to a bit of underperformance in the start of this year.
Absolutely. More on India in just a bit, but also want to sort of highlight why the market is feeling relatively better, at least in terms of the global setup. We've come a long way in the last 48 odd hours, and we've seen that relief rally in Europe. We've seen that in the US, and perhaps two factors. One, I think the market in Europe has had time to digest this whole Credit Suisse UBS deal. And there's still a lot of talk around the $17 billion hit that the AT1, additional tier 1 bondholders are going to take. But more or less, I mean, the way we saw at least stocks yesterday play out, a lot of the bank stocks in Europe started reviving back. So the mood seems to be okay. It's probably contained for now. Let's move on. The ECB, by the way, last week delivered a 50 basis points rate hike, but yet assured the markets that it's standing right there and it's ready to intervene and step in if at all there's any price instability in the market. And I think people expect the same from the Fed.
A word on the AT1 bonds. I guess it's still not been rightly understood by the markets. I was reading some reports from JP Morgan, Citi, and some other global experts as well, and they believe that this is one source of fundraising which will stop for a lot of banks. So there is going to be a problem going forward as to how they raise the capital. So it's not going to be like a one-day event where a central bank comes in and helps you out and bails you out. Look what happened to Yes Bank when the AT1 bond failed.
Oh yes,
right?
It's still going on in the courts.
Still going on in the courts. Right? So it's going to be a bit challenging. So that's what I'm saying. Beyond this Fed meet and the Fed hike of 25 basis points, there are a lot of global puzzles which need to come into place, and we need to take account of that. The only good part from an India point of view, as I keep saying, that we have relatively underperformed. So we have some bit of global negatives priced in the current market price and in the current stocks.
No, absolutely. So I completely agree with you on this point of we need to still be in a wait and watch mode, because the Fed hike or whatever the Fed decision is will be done in the next couple of hours. But after that, what next? So all eyes on some of these mid-sized banks in the US, and the First Republic Bank name keeps coming up in conversations. So we're watching headlines very, very carefully. The last we know is that they have probably gotten JP Morgan on board as an advisor, and they're looking at strategic options. But also what has really helped markets try and move beyond some of these absolute manic moves is an indication, a strong indication from the US government itself that it will step in, it will provide a backstop, perhaps look at a wider deposit guarantee scheme if needed. We had the US Treasury Secretary Janet Yellen making exactly that same point to the American Association of Bankers. So if Yellen is saying something to the Bankers Association, she's putting a very loud message out there to the market that we are around and we will step in and ensure that there's perhaps no more bank runs. I mean, nothing of the nature of what we saw in SVB, but I think we still have to see how some of these smaller banking issues play out, and the overall risk. Anti-risks sort of perhaps mindset in the US.
So the big takeaway from an India point of view is what happens to the Indian IT sector. For the whole of this week, we've seen slew of downgrades coming in for the IT names. The fact that the BFSI is 30% of India's IT companies' revenue, and that's going to hit for sure. Right. So that's where, from an India point of view, we need to be careful about what happens to these regional banks, what happens to the banks in Europe, how they will put out their tech spends for the whole year, and how much it can have an impact on the Indian companies. So the Q4 commentary from Indian players who's got a large BFSI exposure will be very, very closely watched and monitored. If there are cracks, then you'll see further underperformance from the Indian IT names, especially the likes of Wipro, who's got a huge IT exposure, and that's where the big cracks can come going forward. So that is something to track from an India point of view, from what's happening in the global banks, and that's going to have a big impact on the Indian financials.
No, absolutely, and we need to watch more data points from the US as well. For instance, I'll just share one data point that really caught my eye in the last 24 hours. The housing market in the US, for the first time in a decade, house prices in the US have dropped in February year on year. It's a very small drop in house prices, 0.2%, so nothing big. But these are indicators you have to take on board very carefully, because there's still that probability of some sort of a recession, maybe some sort of a semi-hard landing, semi-soft landing. But as you said, this Fed meeting gets over. What happens to the US economy over the next couple of months, how US banks behave in terms of lending, that is something that we need to wait and watch. But before we talk about India, Nimesh, another interesting factor is that markets are so heavily short, right? Around the world. Here in India, I think our FII short positions are at record highs, right?
Yeah, at record highs.
So that probably means that if you get some kind of good news, at least in the interim, there could be very sharp recoveries.
Absolutely. And now, if you look at markets globally as well as in India, the cycles have become very short. I mean, there was a time when we were taught that there is a 7-year bull cycle and a 3-year bear cycle. I guess now within a year and a half, you can easily, as commentators say, it's a bear market and a bull market. So that's how the cycles have shortened so much. So we just have to be on the toes. We just have to monitor every news to the detail T. And you can't take a view, okay, this is a bear market or a bull market. Things will change very fast because central banks are involved. Globally, a lot of large corporations are involved. So there are very high chances that things will change very fast. So we need to be careful and not to take away that this is a bull market or a bear market. We just have to play with the ball. It's like a test match. You have to just make sure that every ball is nicely watched and played accordingly.
You can't be complacent. While of course investing is for the long term, especially if you are an investor, not a trader. But even for investors, I think very important to watch the developments of the next few weeks extremely carefully. That brings us to India, and that brings us to some good news. Now, whatever happens to these global events and what the Fed does, come what may, we've got good news from two big brokerages actually, CLSA and Citi, both getting optimistic.
Both getting optimistic and both putting out largely on the same lines that this is the time to do a contra buying. It's a big statement coming from CLSA, right? I mean, they believe that there is extreme pessimism in terms of sentiment in the market, and that's the reason. That's the time when you need to add beta to your portfolio. Now they have a proprietary India's bull bear sentiment index, and that has hit a 91% bearish level. Okay. Now what this means is whenever this has happened, barring two instances in 2008 and in 2020, okay, there has been 10 such instances in the last 15 years, and 9 out of 10 times this has turned out to be the best entry level to get into the market.
When there's this extreme bearishness.
Such extreme bearishness. So that's a big big thing that because there is so much of bearishness in the market, sentiment is so weak, there is lack of participation. CLSA believes this is the time to get in. And what are they advising clients? They are advising clients that get into the beta names like Reliance, Hindalco, and IndusInd Bank at the expenses of Infosys and NTPC. Now, Infosys has been a rank outperformer within the IT names this year. Look at the underperformers of this year: Reliance, Hindalco, and IndusInd Bank, and all three seems to be high beta for them, and hence they are saying, in this pullback rally, you might see a big move in those stocks. So they are advising clients to add Reliance, Hindalco, and IndusInd Bank in the India model portfolio. Similar is the call from Citi as well. Citi believes that after India's recent underperformance, the risk reward is favorable. And why are they saying this? Nifty is down 6% Y2D, and if you look at India's underperformance to EMs and DM, emerging markets and developed markets, we are down 8% and 11% respectively. Okay,
8% versus developed markets.
8% versus the emerging
markets as a basket,
and 11% versus the developed market basket. So that's why relatively we are looking better off. Also, from a valuation point of view, after the recent correction and the fact that earnings have not fallen so much, they believe that on a relative basis, the premium that India is to enjoy versus the DMs and EM, that is narrowed. Historically, we've gone to 150 as well, and now it has come to sub close to 110 or 120 odd level. So we've cooled off from the very high extreme premium valuations, and that's a bit of positive as well. Even Citi tracks a sentiment indicator, what they call it as CISI. Okay, and that is suggesting that in the very near term, in the next 1 year forward, at least you can expect a mid-teens of returns from the Indian markets. And this
1 year forward, mid-teen returns.
Yes,
fantastic.
And this is actually turned positive after June 2022. So the first time since June 2022, this indicator is turned positive in terms of suggesting that next 1 year you can at least expect mid-term returns.
Okay.
And for that reason, they have a target of 18,500 on the Nifty for March 24. It's still some time away, but at least they have a target of 18,500 on the Nifty. Okay. The good part is even they are looking at adding betas to the preferred list. So in the strategy note, they've added Interglobe Aviation, which is a beneficiary of crude, lower crude as well, and GAIL to the preferred list. Okay. So bottom line is, if you look at the sentiment indicators, which a lot of these foreign brokerages track, it is an extreme bearish level, which means in the near term you might find an opportunity, and that's the reason why you can look to chase some beta and make some good returns, at least in the near term.
Okay, so that's quite an optimistic view from both CLSA and from Citi, saying go out there, get in, buy in the Indian markets, underperformed a lot. Now that's a view. As we start sort of wrapping up the conversation, you talk to so many people on the street, right? So I just want to get a sense of what's going on out there. What are people really saying? It's one thing to say buy every dip, but we haven't seen this sign of that till yesterday. Yesterday was a different day, and some green on the screen today. But we've not seen the big buying happen.
The best part is, despite these big reports from CLSA and Citi, I don't think it's going to cut the ice with a lot of people, and there is a reason for it.
Okay.
Nobody has made money in this market, at least in the last 6 months. Even if you look at the SIP returns of last 1 year, it's either flat or negative. So even the long-term SIP investors are having that pinch of not making any money in the equity markets in the last 1 year. And people have lost money, whether it's traders, whether it's large institutional investors, or whether it's even HNIs. I spoke to a lot of HNIs in the last many days. In fact, I've been on road as well, talking to a lot of guys, and there is absolutely no interest of participating in this market. And normally that's where bottoms are made. So one of the very large investor who runs a family office now, and he was telling me the day before that the way I feel, like there is so much of negativism, I'm feeling so scared, and in the last 15, 20, 30 years of his career, whenever he's felt this bad, the markets have bottomed up. So that's the kind of feeling.
When you're totally detached from the market, when you just don't want to look at it,
you don't feel like participating, you don't feel like buying, or you don't look at opportunities, and that's where markets bottom out. So again, that was a feedback from one of the most influential names. That Nimesh, these kind of feelings is when I go wrong. I tend to become little careful, and that's when market bottoms are made.
Well, let's see if it can really stay as per that. As we wind up the conversation, just leaving you with some perhaps levels in case you're a level sort of a person and you look at the market. A lot of technical analysts are looking out for the zone of around 16,800, 16,850 as a very important support zone, because that's where we kind of turned around in October last year, October 22, September 30th to be precise, and then the market started an up move. as of now in this correction, despite Adani issues, despite central bank issues, banks blowing up, despite all of this, we've not broken that zone of 16,800. So I think that's going to be a big watch point for people. Nimesh, finally, I want to ask you if you're getting any feedback on banks, because everybody knows, everybody knows that there's no connection between Indian banks and what's happening overseas. Yet the problem point for this market has been banking. Naren made a very interesting point today. I mean, that's one view. He gave some logic to it, and I was listening carefully. He said the thing is that there are redemption pressures that mutual funds are facing, and a lot of funds already own a huge amount of banks in their portfolio. So the moment you have redemption pressure, if you have to slightly prune, take profits from your portfolio, banking stocks inevitably end up feeling the heat. So that sounded very logical to me in terms of why pressure. Because otherwise, it's amazing the way these stocks are sold.
Naren was bang on in saying that one of the reasons is because of liquidity and because of the fact that everybody was over-owning it, right? And if you look at Indian markets and the stocks which have relatively underperformed this year, it's largely the large liquid names, okay, which are over-owned by a lot of institutions, whether it's domestic or FIs, and that's where you've seen the underperformance, right? So it's a kind of a positioning, right? I mean, there are times when market is so over-positioned in one sector, and that tends to underperform, and that's why someone like some contra investor like Naren really cuts his eyes. He spoke about pharma today. He spoke about IT from a long-term perspective, not in the near term, but so banking. The problem is everybody was bullish on banking, everybody was owning banks, and they all felt that this bank rally is only going to continue and party will just go on. So I guess that's the reason why banks have relatively underperformed this year.
Okay, well, let's see. We have a couple of very interesting hours ahead, and we'll get that decision later tonight, and then let's see how markets take off from there. In fact, we will be discussing this because once the event is out of the way, then how do you position yourself and look at the market? That's going to be our theme and subject for tomorrow. But Nimesh, thanks very much for joining in today.
Thank you.
All right, that's a wrap on this edition of Who Moved the Market. Thanks for tuning in. We'll see you again, same time, same place tomorrow.